The scariest thing about Bitcoin right now isn't that it can drop 20% overnight, it's that someone might be able to engineer that drop without ever touching Bitcoin at all. Using nothing but paperwork, incentives, and a countdown clock hidden inside a public company's balance sheet. If you want more investigations like this, where we follow the money, not the rumors, hit subscribe right now. Because what you're about to hear will change how you interpret every normal dip on the chart. It started the way all market crimes start, not with a crime, but with a feeling. You finally buy $104. November 2024. Convinced you did everything right. ETFs are live. Institutions are here. The headlines feel like destiny. Then the price doesn't follow the script. Bitcoin stutters between $85 and $98 like it's trapped in a hallway with invisible walls. And you start asking the most dangerous question in markets: what am I missing? The easy answer is the one everyone repeats at 2 a.m. Banks are manipulating it. It sounds like conspiracy theater, smoke-filled rooms, secret calls, villains in suits. I didn't buy it either. Not because banks are too moral, but because banks don't need to be illegal to be lethal. Real financial warfare isn't a robbery. It's a contract you signed that becomes a trap the moment conditions change. I did what investors should do more often. I stopped staring at the candlesticks and started reading the mechanics. I pulled old cases, old playbooks, old disasters, the kind that look like unrelated history until you realize history isn't random, it's a library of repeatable methods. And one method kept appearing like a fingerprint at multiple crime scenes: pressure through debt denominated in something you can't control. In 1982, Mexico borrowed billions in US dollars. It made sense on paper: build infrastructure, grow the economy, pay it back later. But there was a fatal design flaw: Mexico couldn't print dollars. When US rates rose, the dollar strengthened, Mexico's payments exploded, and suddenly the nation wasn't developing, it was bleeding. The rescue that followed came with conditions: sell assets, cut spending, open markets, surrender leverage. It wasn't a gun to the head, it was a spreadsheet that forced the same outcome. That's when the case stopped being about Mexico and started being about psychology. Because debt spirals don't just break countries, they break decision-making. The moment you're worried about a payment, you stop thinking like a builder and start thinking like a hostage. You sell too early, you refinance badly, you accept terrible terms just to survive one more month. And the lender doesn't need to commit a crime, they just need to have positioned themselves so your fear becomes their profit. Now scale that idea down to something personal: a homeowner with a variable rate loan. At first the payment is fine. Then rates jump, the payment doubles, income doesn't, the homeowner panics, and panic makes people liquidate at the bottom. The bank didn't manipulate the house, it manipulated the structure. It created a situation where normal rate changes become a lever that moves your life. Then I asked the question that turned this from a story into an investigation: what happens if the house isn't a house at all, but tens of billions in Bitcoin sitting inside a publicly traded company with obligations that don't care about narrative, hype, or long-term belief? Because somewhere in the market there is a single entity that functions like a giant Bitcoin vault, except the vault has monthly bills. And those bills are paid in dollars, not dreams. That entity is MicroStrategy, now rebranded as Strategy, officially a software business, and officially a leveraged Bitcoin machine. The mechanism is elegant: raise money through stock, convertibles, preferred shares, then buy Bitcoin. If the market loves the story, the stock trades at a premium to the Bitcoin it holds, and the company can sell shares, buy more Bitcoin, and repeat. A flywheel forms: premium funds purchases fuel hype, hype supports premium. It looks unstoppable, until you realize flywheels can spin in reverse. Here's the first dark hinge of the case. The entire machine depends on one fragile condition: confidence in the premium. If that premium collapses, the company's easiest funding channel chokes off. And if obligations still must be paid, the pressure shifts to the only liquid asset big enough to matter: Bitcoin itself. That's the moment a Bitcoin story becomes a balance sheet deadline, and once a deadline exists, the market begins to circle it like sharks that can smell time running out. The second hinge is something most retail investors never track because it isn't on the Bitcoin chart. The company's obligations don't pause for bull markets. Interest payments arrive on schedule. Preferred dividends, depending on the structure, can be treated like a heartbeat the market expects to keep hearing. A normal company pays those bills from operating cash flow, but a company that transformed itself into a Bitcoin vault has a problem. Software revenue was never designed to feed a machine this large. That's why the smartest part of the strategy is also the most dangerous. They built the system to survive on financing, not earnings. In good times, financing is oxygen. In bad times, it becomes a choke collar. Because financing isn't just money, it's permission granted by the market's mood. When the mood shifts, the same market that once paid a premium starts asking a colder question. Why am I paying extra for what I can buy directly? And here's where the story begins to smell like a deliberate setup. Not a conspiracy in a smoky room, something more realistic. A set of incentives so clean and so legal that you don't need coordination. All you need is for enough players to realize the same trade exists. Then act on it independently, like wolves hearing the same distant bell. Imagine you're a large bank with clients who want Bitcoin exposure, pension funds, endowments, sovereign funds. Their rules are strict, custody is political, volatility is a risk committee's nightmare. So they look for routes that feel institutional, ETFs, structured products, equity proxies. Now imagine there is a scenario where those clients can end up with Bitcoin not at market price, but at a discount, simply because a leveraged holder is forced into a distressed sale. Distressed sales don't happen on a public exchange the way retail imagines. They happen quietly. A phone call, a short list of counterparties, a block trade with a haircut. The seller says, "We need to move size." The buyer says, "Then you need to pay me to take the risk." And in a single private transaction, billions in Bitcoin can change hands at a price the chart never fully reflects until later. That's the mechanism that makes the price suppression idea plausible without requiring magic. You don't have to push Bitcoin down directly. You push a structurally vulnerable intermediary into distress, then wait for the forced seller moment. The discount becomes the prize. The public sees a dip. The private world sees inventory being acquired. Now the question becomes brutally simple. How do you create distress in a public company that holds Bitcoin? You don't need to attack Bitcoin. You attack the company's equity. Because equity is the air supply of the flywheel. Cut off the air, and the machine starts starving. The tool for that is ordinary, legal, and older than everyone watching this video: short selling. The short seller doesn't need to prove Bitcoin is worthless. They only need to pressure the stock enough to collapse the premium. Because once the premium is gone, fundraising becomes painful, and the countdown clock grows louder. And the closer you get to a deadline, the more every rumor, every downgrade, every negative note lands like a match near gasoline. This is the part retail investors hate hearing. In modern markets, research reports can function like weather forecasts that also shape the weather. If a major bank publishes a note warning that a stock is overvalued, that it may fall out of an index, that forced selling could occur. The market doesn't treat it as one opinion. It treats it as a potential self-fulfilling mechanism. Not because the bank is omnipotent, because passive funds, algorithms, and committees respond predictably to predictable triggers. And once you see how those triggers stack, you start to understand why the whole thing feels like an invisible hand. A stock gets pressured, the premium compresses, liquidity thins, volatility rises. Volatility triggers risk limits trigger selling. Selling validates the bearish thesis. The thesis invites more shorts. The loop tightens. Nobody needs to meet in a room. The structure coordinates everyone for free. To see how clean this can be, you have to look at an older crime scene. In the early 2000s, there was a financing structure that destroyed real companies without a single masked intruder breaking a law. It was called pipe financing, private investment in public equity, and in its nastiest form it became a weapon, the floorless convertible. The logic was simple and evil in the way only spreadsheets can be evil. A struggling company needed cash. A fund offered money, but repayment was in stock, not dollars, and the lower the stock went, the more shares the lender received. That one clause flipped the moral gravity of the deal. In a normal loan, the lender wants the borrower healthy. In a floorless convertible, the lender profits from the borrower's stock collapsing. The borrower thought they were buying time. They were buying a trap. If you hand someone a contract where they get more of your company as your price falls, you have effectively paid them to pressure your price. They don't have to manipulate, in the criminal sense. They can short, hedge, publish pessimism, lean on liquidity. and let the structure do the rest. The market punishes uncertainty. The financing creates uncertainty. The uncertainty drops the price. The drop increases the shares owed. The shares owed increase dilution fears. Dilution fears drop the price again. It's a loop with a smiley face drawn on top of it. Regulators did investigate waves of abuse in that era, and the pattern was consistent. Companies that entered these deals often bled out fast. Some collapsed entirely. The public saw bad businesses. The funds saw a repeatable extraction method. And the terrifying lesson for our case is this: the extraction did not require illegal coordination. It required a structure with incentives that aligned destruction with profit. Now, Strategy's capital structure is not a carbon copy of those floorless convertibles. This is important. The internet loves lazy parallels, but the psychological geometry can still rhyme. When a public vehicle holds a concentrated asset and depends on capital markets' confidence, pressure on its equity can become pressure on the asset it holds, especially if obligations force liquidity. Here's where the investigation turns from history into present-day tactics. The modern market has more instruments than ever: options, swaps, index inclusion rules, passive flows, volatility targeting. You can create pressure through the stock without ever announcing you're doing it. You can bleed sentiment through price action. You can create chart ugliness that triggers retail panic and committee caution. And you can do it all while staying inside the guardrails of legality. A hedge fund doesn't need Bitcoin to fall. It needs the equity proxy to wobble. Because if Strategy's stock trades below its underlying Bitcoin value for long enough, the narrative flips from genius flywheel to leveraged risk. Once the narrative flips, capital becomes expensive. Once capital becomes expensive, the company's options narrow. And once options narrow, forced selling becomes plausible. At that point, the market doesn't even need certainty. It only needs doubt. Markets price the possibility of disaster long before disaster arrives. That's what makes them brutal. The price becomes a rumor machine. The more it drops, the more something must be wrong. The more something must be wrong, the more it drops. And somewhere in that spiral, you can manufacture a discount without manufacturing a lie. The cleverest twist is that none of this proves a villain exists. In fact, the system works better without villains. Because when outcomes can be produced by incentives, everyone can claim innocence. The short seller says, "I'm hedging risk." The bank says, "I'm publishing research." The passive fund says, "I'm following rules." The algorithm says, "I'm following volatility." And the retail investor says, "Why does it feel like I'm always late?" This is the moment in the story where the loophole becomes clear. The loophole is not a secret door in Bitcoin. It's the ability to influence Bitcoin's market experience by targeting a leveraged Bitcoin holder's financing conditions. You don't need to control Bitcoin. You only need to understand where the pressure points are, where a countdown clock meets public sentiment, and then let the structure squeeze on your behalf. Picture a different scene than the one retail imagines. Not a screaming exchange, not candles flashing red, but a quiet call late in the day. A treasurer, a CFO, a broker, a handful of names that never trend on Twitter. The seller doesn't announce, "We're distressed." They say, "We need liquidity and we need it now." In institutional language, distress is always phrased as efficiency. The buyer replies with the oldest line in finance, "We can do it. But we need terms." And the most important term is almost always a discount. Not because the buyer is evil, but because size is risk. If you buy billions of an asset in one bite, you inherit the possibility that price moves against you before you can hedge or distribute. The discount is a risk premium that looks like a bargain. This is why block trades are the dream scenario for anyone trying to accumulate quietly. You don't fight the market for liquidity. Liquidity comes to you, begging. You don't pay the public price. You negotiate a private one. And once you have inventory, you can do what institutions do best: slice it, hedge it, package it, or simply sit on it while the narrative resets. Now step back and notice what's happening psychologically on the outside. Retail investors see Bitcoin drifting, failing to explode upward despite constant adoption headlines. They grow impatient. Impatience turns into doubt. Doubt turns into selling. And every bit of selling pressure makes it easier for the private market to demand better terms from the next forced seller. The public panic becomes a tool that lowers the private acquisition cost. If you want to understand how sophisticated investors smell these moments, stop asking, "Is Bitcoin being manipulated?" and ask, Where could the next forced seller come from? Forced selling is the only form of selling that consistently creates discounts. Voluntary selling is debate. Forced selling is gravity. In this case, strategy is not the only possible forced seller, but it is a symbolic one because it is so visible and so concentrated. When the world's loudest Bitcoin holder becomes structurally stressed, every other leveraged actor becomes suspect in the market's eyes. That suspicion alone can tighten credit conditions, raise haircuts, and make refinancing harder. The fear spreads without needing a single leak. And here is the ugly truth investors learn late. Markets don't wait for quarterly reports to form conclusions. They front-run them, they infer, they guess, they build probability trees, then price those trees like they are already partially real. If a company has obligations and the asset it holds is volatile, the market will constantly price the chance that volatility and obligations collide at the worst time. That is why countdown clocks matter. If the market believes there is a deadline where liquidity could run thin, it begins to treat every dip as evidence. Even if the dip is normal noise, noise becomes narrative, narrative becomes positioning, positioning becomes price, price becomes the proof the narrative was right. This is how a timeline becomes a weapon without anyone holding it. Now let's make this even darker. Because the most effective pressure isn't always direct. Sometimes the market creates a situation where doing the right thing feels impossible. If you're the CEO watching your stock get hammered, you face 3 bad doors: raise equity and dilute shareholders, sell Bitcoin and confirm the bear thesis, or do nothing and let the clock tick louder. The attacker doesn't need you to choose the worst door. They only need you to feel trapped. And when a leader feels trapped, they communicate differently. Their tone changes. Their confidence becomes defensive. Their language becomes over-explained. The market hears that shift like a cracked note in a song. Suddenly, even loyal investors begin to wonder if the flywheel is still a flywheel or if it's turning into a centrifuge. That's when the real sell-off begins, not because of numbers, but because of belief. In the files I kept returning to, one recurring character kept showing up, not a person, but a type. The hedge fund that doesn't bet against Bitcoin. It bets against fragility. It doesn't need the asset to fail. It needs a structure to wobble. And when it finds a structure built on premium, confidence, and refinancing, it treats that like a bridge with hairline cracks and waits for the first heavy truck to roll over it. The strategy looks boring on the surface. Long Bitcoin, short the proxy, or short the proxy, hedge with options, and keep the position delta neutral while hunting for volatility. The goal isn't to predict the future like a prophet. The goal is to position so that any stress event pays you. If the stock drops faster than Bitcoin, you win. If the premium compresses, you win. If a refinancing headline spooks the market, you win. It's not a directional bet. It's a structural bet. And here's the part that feels like manipulation to anyone watching from the outside. The fund can add pressure without ever lying. It can request borrow, increase short interest, and let the tape speak. It can buy puts and force market makers to hedge. It can create what traders call ugly price action, the kind that makes retail feel like the chart is personally insulting them. The chart becomes the message, and the message becomes fear. Then comes the cleanest weapon of all: opinion disguised as caution. A note goes out, a report drops, a podcast guest says the structure is risky. None of it has to be false. It only has to be framed around worst-case mechanics. What if the premium flips? What if the company can't raise? What if index funds are forced to sell? These questions are legitimate, but when you stack them on top of a shaky chart, they turn into a mood. And mood is the currency that funds raise and destroy with. In my notebook, I wrote a line that felt cruel but accurate. The market doesn't need proof. It needs permission. Once a bearish narrative gives institutions permission to reduce exposure, they will, not because they hate you, because their job is not to be brave. It's to be defensible. They would rather miss upside than be the person who held the risky thing when a committee asks, "Why didn't you cut it?" This is where the subplot begins. The one most people never notice: the internal politics of capital. A portfolio manager might love Bitcoin, but the risk officer loves sleep. The investment committee loves plausible deniability. The compliance team loves headlines that justify caution. So when a narrative about structural risk spreads, it doesn't just move traders. It moves the slow, heavy creatures of finance, allocations, mandates, and passive rules that shift billions without any emotion at all. And those slow creatures create the perfect environment for accumulation. Because while the public argues about whether Bitcoin is dead again, sophisticated players are watching micro signals. How quickly dips get bought. Where options open interest clusters. How funding behaves. Whether large holders are distributing or simply rotating custody. The street doesn't need a villain. It needs a crowd that panics on schedule. I followed one hypothetical fund through this logic like a detective reconstructing a crime. Step 1. Identify the vulnerability, premium dependence and refinancing sensitivity. Step 2. Take a position that benefits from premium compression. Step 3. Add convexity with options so the payoff grows when volatility spikes. Step 4. Wait for any catalyst, earnings, macro shock, a downgrade, a policy scare, to hit the tape. Step 5. When the stock breaks, watch liquidity thin, then watch the narrative confirm itself through price. The fund doesn't have to push the boulder down the hill. It only needs to place itself at the bottom with a bucket. Because once panic starts, it accelerates naturally. Retail sells because they can't stand regret. Institutions sell because they can't stand blame. Algorithms sell because volatility tells them to. And in that chaos, the fund either closes profitably or stays positioned for the next phase, the distressed inventory moment. That's the real signal of a discount hunt, not a tweet. Not a rumor, but a shift in behavior. You'll see volatility spike around predictable dates. You'll see the proxy underperform spot repeatedly. You'll see the market obsess over balance sheet language. You'll see every dip treated like an indictment rather than a fluctuation. And when that happens, you should understand one thing. You are not watching a simple Bitcoin chart anymore. You are watching a negotiation between fear and liquidity. And the side with the longer timeline usually wins. Now we reach the part of the story where the market turns personal. Because the chart doesn't just move, it accuses you. It makes you feel stupid for believing. It makes you feel late for buying. It makes you feel trapped for holding. And that emotional pressure is not a side effect. It is the fuel that transfers assets from impatient hands to patient ones. The manufactured part isn't always the price move itself. It's the timing and the framing. The dip happens right after you felt safe. The drawdown clusters near a deadline you didn't know existed. A headline appears that sounds definitive but is actually conditional. And your brain, desperate to end uncertainty, reaches for the fastest relief. Sell. That is the moment a long-term thesis dies, not because the thesis was wrong, but because the holder ran out of emotional capital. In this case, the emotional trap is amplified by a strange paradox. Institutional involvement can increase short-term pain. When more sophisticated players arrive, they don't just buy spot and pray. They hedge, they arbitrage, they pressure weak structures, they hunt discounts, they turn markets into chess instead of roulette. And if you're still playing roulette while they're playing chess, the same board will feel rigged even when it's simply more advanced than you. So what does the professional do in the middle of a storm? They change their questions. Retail asks, is it going back up soon? Professionals ask, what are the constraints? Constraints are real. Narratives are optional. A constraint might be cash runway. A constraint might be refinancing terms. A constraint might be covenant language. A constraint might be whether a company can issue equity without destroying confidence. Those constraints determine whether forced selling is possible. This is where the detective's flashlight becomes practical. If a leveraged holder truly risks a spiral, you'll see it show up first not in price but in communications. The tone changes. The company starts emphasizing liquidity management. They start highlighting cash reserves more aggressively. They talk about opportunistic financing as if they're reassuring themselves. Then, in filings, you see the language become precise about obligations and timing. Paper is where stress leaves fingerprints. The second place you watch is the proxy's relationship to the underlying asset. If the proxy repeatedly trades like it's sick while Bitcoin looks merely tired, that's a signal the market is targeting structure rather than thesis. If the proxy's premium compresses hard and stays compressed, that's another signal. It means the market is no longer paying for the flywheel story. It's paying only for what it can touch, the BTC, the liabilities, the calendar. The third place you watch is the refinancing environment itself. Because a spiral can be prevented by one thing: time purchased at acceptable cost. If rates ease, if credit opens, if the company can roll obligations without bleeding, the entire forced selling Narrative collapses like a cheap tent in wind. That's why countdown clocks are hated by markets. They are visible vulnerabilities. And anything visible becomes a target. Here's the key twist most people miss. Even if institutions were trying to acquire Bitcoin cheaper, that is not bearish for Bitcoin. It is bearish for impatient holders. If the smart money is engineering discounts, it means they want the asset. They're not ignoring it. They're not dismissing it. They're investing effort into owning it at a better price. Worthless assets don't get complex tactics. Worthless assets get silence. That leads to the cruel logic of wealth transfers. When Bitcoin dips 20%, retail thinks, I'm losing. Professionals think, who is being forced? Retail looks for reassurance. Professionals look for imbalance. Retail seeks comfort. Professionals seek inventory. And in a market built on volatility, the majority will always sell when their nervous system demands peace. The minority will buy when their process says opportunity. So if you're holding Bitcoin and this story scares you, do one thing. Replace emotion with a checklist. Ask whether fundamentals change. Ask whether a forced seller is confirmed or merely imagined. Ask what the next 6 to 12 months of constraints look like. Markets are not moral. They don't reward belief. They reward preparation. And the most dangerous mistake you can make is selling in the exact moment the system is designed to make you feel maximum regret. The final chapter of this case isn't about predicting a number on a chart. It's about recognizing a pattern before it finishes forming. Because by the time the headlines scream, manipulation, the accumulation is usually already done. The real edge is seeing the shape of the trap while it still looks like normal volatility. Signal 1 is the calendar. Not the Bitcoin halving calendar. Not the macro calendar, but the hidden corporate calendar, reporting cycles, refinancing windows, cash runway estimates, moments when liquidity questions become unavoidable, when the market starts clustering fear around specific months rather than general, bear vibes. That's the scent of a countdown clock becoming a trade. Signal 2 is repeated proxy weakness. If the equity proxy underperforms Bitcoin again and again, especially on down days, it means pressure is being applied where the structure is fragile. This is where the public misreads the situation. They assume Bitcoin is weak. The professionals see something else, an attempt to compress premium, choke financing, and make the holder's optionality expensive. Signal 3 is narrative convergence. When unrelated voices begin repeating the same phrases, overvalued, structurally risky, index removal, forced selling, it doesn't prove coordination. It proves the trade has become obvious enough that many actors are arriving at the same conclusion. Markets don't need collusion when incentives point in one direction. Groupthink can do the job for free. Signal 4 is volatility behavior. Not just that volatility rises, but that it rises in specific places, around key dates, around earnings, around financing announcements, around moments when a company's ability to raise capital is questioned. Volatility becomes a tool because it changes behavior. It scares committees. It triggers algorithms. It convinces retail that something is wrong, even when the only thing wrong is that volatility is doing what volatility always does, flushing weak hands. Signal 5 is the most important and the most boring, paperwork confirmation. If a leveraged holder actually sells Bitcoin to meet obligations, you will eventually see it, not as a rumor, but as disclosure. That is the line between theory and reality. Until that line is crossed, most of what people call manipulation is simply the market pricing risk. Aggressively and sometimes cruelly, in advance. Now let's close the file with the 3 fatal mistakes retail makes in this kind of environment. The first is panic selling into uncertainty. Retail wants certainty before buying. Professionals buy when uncertainty is highest because that's when discounts exist. Retail sells to end discomfort. Professionals endure discomfort to capture asymmetry. The second mistake is confusing a proxy's problems with the asset's thesis. A company can be poorly structured. A company can be over-leveraged. A company can be trapped by its own design. That does not automatically invalidate Bitcoin's long-term narrative. It means one vehicle has a vulnerability that the market can exploit. Don't let a single structure become your entire worldview. The third mistake is thinking the market needs to cheat to beat you. That belief is comforting because it turns your losses into someone else's crime. But the truth is sharper. Markets can extract wealth through legal incentives, psychological pressure, and predictable human behavior. They can defeat you without lying to you. They can take your position simply by making you tired of holding it. And that's the last, haunting lesson of this investigation. The loophole isn't a secret switch that controls Bitcoin. The loophole is that your emotions can be priced, triggered, and exploited at scale, through structures that convert time into pressure. The way to win isn't to find a villain. It's to become the kind of investor who cannot be forced by narrative, cannot be rushed by volatility, and cannot be shaken by a countdown clock you didn't even know was ticking. If you want more cases like this, where we decode the mechanics behind the madness, subscribe. Because the next investigation won't be about Bitcoin at all. It'll be about the next asset where the structure, not the story, becomes the battlefield.